This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our first session together on inheritance tax, IHT as we call it, we discovered that for the majority of taxpayers, the one and only time that they would have contact with the IHT system is sadly when they die. And that when they die, there are two main computations that need to be prepared. There are firstly any lifetime transfers made within the 7 years before the date of death that need to be individually charged to IHT. How do we charge to IHT? We have a main rate on death of IHT of 40%. Before we start to charge any such transfers at 40%, we are firstly able to use up our available nil rate band. That nil rate band, currently £325,000, and has been such for many, many years now. That would firstly be applied on a first-come, first-served basis, on a chronological basis, against those lifetimes made within the 7 years before death. We spoke of transfers being made 6 years before death, 4 years before death, 2 years before death, and the available nil rate band of 325 used in that order, thus benefiting the earlier transfers before the later transfers. It was that issue that made us point out the concept that IHT is a cumulative donor-based tax, i.e. the amount of any inheritance tax that may become payable on those gifts made to different people 6 years ago, 4 years ago, 2 years ago, that the amount of tax that may be payable on them is nothing to do with the recipient of the £200,000 gift. I used a figure of 200,000, you may recall, and will do in the examples coming up in a few minutes' time. But the amount of tax payable on whatever gift was nothing to do with the recipient, it was everything to do with the donor. It was a cumulative donor-based tax. So the first transfer used up any available nil rate band. Onto the second transfer, 6 years ago to 4 years ago. Is there any nil rate band still available? If so, use it, the balance at 40% tax. The third such transfer 2 years ago, any nil rate band? If not, all the 325 has been used, then it's all at 40%. So exactly the same gifts made 6 years ago, 4 years ago, 2 years ago could have very, very different amounts of tax. The amount of tax had nothing to do with the recipient. It will be, as we will see though later, the recipient of the lifetime gifts, where those gifts become chargeable on the death of the taxpayer, because sadly the taxpayer dies within 7 years of having made them. Although the amount of tax to be paid is nothing to do with the donee, the recipient, it is the recipient, the donee, who will have to make the payment of tax. Once we have dealt with the lifetime transfers made within the 7 years before death, it is then the chargeable estate that we deal with. The chargeable estate, the listing of the assets held by the taxpayer, using any valuation rules. We learned a couple of such valuation rules here in section 3, as you can see on the screen there, but we list them out, and then having listed them out, the lifetime transfers made, having then got to the death estate, listed out the assets held, we deduct from them any debts or liabilities due, and we'd also then deduct any bequests that are exempt, which is basically anything you give to your spouse or civil partner there. Now, we've mentioned about the available nil rate band. The next section of this lecture deals with not just the main nil rate band that we have referred to during our first lecture, but there's going to be another new nil rate band, something called a residence nil rate band, that's come in purely from this tax year 17-18 onwards. So we'll need to deal with that as well. Let's have a look at the available nil rate band that every taxpayer benefits from. Now, the available, in inverted commas there, nil rate band is deducted from the value of the chargeable estate. The nil rate band itself is 325,000, as we know, But what we mean by the available nil rate band, as we've just said, is that 325 reduced by the value of any lifetime chargeable transfers made by the deceased in that specific period 7 years before death. The balance of the estate is then taxed at 40%. It then starts to discuss there about this new residence nil rate band. More of that in a moment. Let's have a little look at illustration 2. Where we have illustration 2, the humorously entitled Departed, a spinster. That means that she was never married, a lady who never married there. Sadly died on the 1st of February 18, so dies within the 1718 tax year, leaving an estate valued at 0.75 million, which included, and often the main asset of value in your estate would be your main residence. That happened to be valued at 0.3 million, some £300,000. She had made no chargeable transfers of value in lifetime and now bequeathed her estate to be split equally between her nieces and nephews. Spinster, never married, no husband, no spouse exemption therefore to apply, and no kids, and that means that, well, her nearest and dearest are her nieces and nephews. Compute the IHT liability arising as a result of D's death and state the date by which the liability should be paid. Again, if you look just up here in relation to this note, the IHT liability has to be paid by the personal representatives before they get letters of probate, there's a lovely term, allowing the estate to be distributed. But when is it due? 6 months there after the end of the month in which the taxpayer died. The IHT is suffered by the beneficiaries. It's not the personal representatives who have to pay out tax from their money. They take the money out of the death estate. So there is less, therefore, to go to the beneficiaries, so that it is they that suffer that IHT. Usually someone will come back to this term later. The residuary legatee of the estate is the person who usually is the one who suffers that. And that person is the person receiving the balance of the estate after any specific legacies have been paid out. Don't worry about that at this point in time. All we need to know at this point is when do the personal representatives have to pay? 6 months after the end of the month in which the death occurred. So we ought to compute the liability arising as a result of D's death, the date by which the liability should be paid. When did D die? 1st of February 18. 6 months after the end of the month in which the death occurred. 6 months from the end of February. Well, add it through, get your fingers get your fingers out there and start adding through. That will take you through to the end of August. So it'll be the 31st of August 18, at which date any IHT payable, we'll calculate that right now, has to be paid over to HMRC, and it's paid by the personal representatives. They take the money out of the estate and pay that over. There is therefore less left within the estate to go to the beneficiaries of that estate. The estate is a simple one. The chargeable estate at death, state the date of death, February the 1st, 18. What the value of the net assets? 750. Right. Will all of that 750 be charged at the main rate of 40%? No, it won't. There had been no lifetime transfers. So the full nil rate band is the available nil rate band. It's 325,000. At nil, no tax to pay. Leaving out of the 750,000, 425 that is now pushed up into the main rate band of 40%. 40% on 425 is a formidable amount of tax now to be paid on that estate, £170,000. The note, you do not know anything yet about the residence nil rate band, but something to note for in a few minutes' time when we look at this. The residence nil rate band is not available as the main residence was not left to a direct descendant, children or grandchildren there. Only then would it be available. Sadly, Dee did not have any children of her own, therefore, nor grandchildren. It was going to the nieces and nephews. What we do need to know, who pays it? The personal representatives. will be required to pay the liability, here £170,000, by the 31st of August 18, i.e. 6 months after the end of the month in which the taxpayer died. The tax will come out of the estate and hence is borne by the nieces and nephews, the so-called here residuary legatees. So there was assets worth £750,000 left by departed there, tax on that coming out of the estate 170, so 750 minus 170 would be what, £580,000 worth of estate to go to the nieces and nephews. Personal representatives pay the tax, leaving a balance after tax here of, I think if my mental arithmetic is right, £580,000 to go to the nieces and nephews, the beneficiaries there. Okay, now then, we've skipped over the residence nil rate band, and I'll come back to that in a little while. What I'd now like to do, so as to again not have to worry for the moment about another nil rate band coming in, the so-called residence nil rate band, we'll move on to illustration 4 to cover something that we've spoken about already in this lecture and we mentioned extensively in our first lecture together. Now, illustration 4, as in the one we've just done, illustration 2, but D had made a chargeable transfer of value of £200,000 in June 15. In our first example, she'd made no lifetime gifts. Now, a chargeable transfer of value of £200,000 in June 15. Compute the liability arising as a result of D's death. Because there are now, or there is a lifetime transfer, there are two computations that would be required. The first computation, lifetime transfers chargeable on death. As the chargeable transfer made in lifetime falls within the 7 years before the date of gift, before the date of death, I beg your pardon, June 15 compared to 1st of February 18, this is within the 7 years before death, it will become chargeable as a result of D's death. But of course, no problem, it falls within the nil rate band of 325. Remember, we apply the nil rate band firstly to lifetime transfers, and as we'll see in a few more minutes' time, we apply that on a strictly chronological basis. If there were more than one lifetime transfer, the earliest, the first one, first within the 7 years before death, it gets to use the nil rate band before any later transfers. It will, however, fall within the nil rate band of 325 in force at the date of death, or we use the nil rate band in force at the date of death when computing any IHT due as a result of death. That figure, though, has been 325,000 for many, many years. So no IHT will be payable on that transfer because 200,000 is less than 325. But what it will mean is that now we've used 200 out of the 325 nil rate band, so only 125,000 of the nil rate band now available in taxing the estate at death. So now the IHT payable on the chargeable estate will be computed as follows. Now, IHT on death estate, only 125 remained. You'd explain where the 125 came from. 325 nil rate band less the 200,000 used on the lifetime transfer made in June 15. 125 at nil. Now that pushes more of the 750,000 up into the 40% band. So now 625,000 of the estate is taxed at 40%, pushing up the tax charge to 250. Again, you can see this is a cumulative donor-based tax. We have exactly the same chargeable estate at death, 750, but the amount of tax payable on that is a very different number. It's gone up from 170,000 to £250,000 there, simply because we had a lifetime transfer made within the 7 years before death that has therefore used 200 of the 325 nil rate band. Now there, in illustration 4, there was only one lifetime transfer made. Of course, our taxpayer may have been more generous in lifetime and made 2 or more transfers. So let's just move on to look at a note about these lifetime transfers. We've just been referring to them as lifetime transfers, but the type of transfer we've been talking about, the transfers of value that we've been talking about, the gifts in lifetime, have been these: potentially exempt transfers, which we can abbreviate to the acronym PET. There's a lovely term. Yeah, we're all pet lovers here. Potentially exempt transfers. Think about that name, potentially exempt transfer. You know that when a gift is made in lifetime to anybody other than into a trust, where, again, you may or may not recall from the first session, those were very special, those were kept different, those were kept separate, they were taxable when made in lifetime. But to any other individual other than your spouse that is exempt there, a PET, potentially exempt transfer, when you make it, there was no lifetime tax to pay. The only time you would have to pay any tax on a lifetime transfer was if the taxpayer, the donor, died within 7 years. So when it's made, it is potentially exempt. Live for more than 7 years, what was potentially exempt when made will be exempt. Hence the name. When made, it is a potentially exempt transfer. So a PET is a lifetime gift made by an individual to another individual. This is other than your spouse or civil partner that are exempt transfers. So they will never be chargeable whenever you die. With a PET, the original assumption is that the gift will be exempt IHT. Therefore, no IHT liability at the date of the gift. As we've just said, if the donor survives more than 7 years from making the gift, the PET becomes fully exempt and is ignored for IHT purposes. Something you don't yet know, that we've been talking about a transfer of value. We've been talking here about a chargeable transfer of value, that actually when you make a transfer in lifetime, you might get some deductions for exemptions against that gift. We'll talk about those later. At this point, we've made a chargeable transfer. If the donor survives for more than 7 years from making the gift, that PET becomes fully exempt and is ignored for IHT purposes. If sadly the donor dies within 7 years, like in our example of a moment ago, where the transfer was made in June 15, and the taxpayer sadly died in February 18, didn't last for 7 years, didn't survive for more than 7 years, therefore it became chargeable on the death of the donor. IHT is then payable at 40% on what? The value of the gift less any available nil rate band. We had a gift of £200,000 and the nil rate band was, as you recall, £325,000. So there was, therefore, no tax to pay on it, and it left £125,000 in nil rate band to go and be charged against or to be deducted from the estate at death. So, to repeat, in terms of a potentially exempt transfer, no immediate IHT liability, only becomes chargeable if the donor dies within 7 years of making the gift. That becomes chargeable on the death of the donor and will then be payable at 40% on any value of the gift over and above any available nil rate band. If the taxpayer did survive for at least 3 years, however, from the date of the gift, so doesn't last for 7 years, so it becomes chargeable, but if they had survived for more than 3 years, then any IHT charge, if there is any, is reduced by something called available taper relief. So what we have is a situation where if your taxpayer lives for more than 7 years, then there is no tax to pay as a result of their death on a gift made more than 7 years before they died. But imagine the situation whereby the taxpayer lived for 6 years, 300 and 60 days after having made a lifetime transfer. And then, sadly, one day on the way to work, rather than being on the bus, they're under the bus, and therefore they die. Such bad luck. Obviously, such bad luck for the individual, but bad luck for the individual who received that gift 6 years, 360 days before the death now of the taxpayer. Because that's within 7 years. It would become chargeable. It would seem harsh, therefore, for a full tax charge to arise where that individual so nearly made it in terms of their gift to more than 7 years from the date of death. So what happens is we have a taper relief, that if the taxpayer survives for at least 3 years, but not 7, though the pet becomes chargeable, the amount of tax that may be payable is reduced by a scale. It's again given to us in terms of our tax rates and tables, but again, the taper relief will apply to reduce any tax charge. More of that later. But let's see how we deal with cumulative transfers. As in illustration 4, but this time D had made 2 chargeable transfers in lifetime, each of £200,000. The first in June 15, the one that we had before, and now a second one in August 16. And we've got to compute the IHT liabilities arising as a result of D's death. So, as D has made, oh, pardon me, as D has made now 2 lifetime transfers, both of these to various individuals in lifetime, we've labelled them as pets, potentially exempt transfers. Has made pets within 7 years of the date of death. These now become chargeable along with the chargeable estate, and the IHT may be computed as follows. Firstly, what becomes chargeable and what gets the use of the available nil rate band. We head up a computation, lifetime transfers chargeable on death. Go back to the earliest such transfer. There were 2 of them, the earliest in June 15, the second the later in August 16. Back to that first transfer, made within 7 years of the date of death of the taxpayer. Date, June 15. What is it? It's a potentially exempt transfer. What was the amount? I'll explain later this term gross transfer, but that's the language we use. It was 200,000. 200,000 is entirely within the 325,000 nil rate band. Therefore, how much tax to pay? No tax to pay. On to the next transfer. Second one in August 16. Again, it is a pet that now falls within the 7 years of the date of death, so it becomes chargeable on death. We've already used up 200,000 of the nil rate band. So the available nil rate band for this transfer is 125,000. At nil, obviously no tax. So out of the 200,000, a further 75,000 is pushed up into the 40% band. 40% on 75,000 is £30,000, £30,000 of tax in total, therefore, to pay. That 30,000 liability will be paid by the donee of the gift. Again, although the amount of tax is nothing to do with the donee, look, 2 equal transfers of £200,000 apiece there. That one, the first one, fully enjoyed the use of the nil rate band, no tax to pay. The second one only had the remaining 125,000 of the nil rate band, 30,000 to pay. Different beneficiaries, same amount of transfer, the amount of tax nothing to do with the beneficiary. It is a cumulative donor-based tax. Hopefully we got to see that now. Now then, we mentioned about that if there is tax to pay, that tax may be reduced by something called taper relief. But that is only if you survive for more than 3 years from the date of the transfer to the date of death. So, as the August 2016 pet, is less than 3 years from the date of death, that was the 1st of February 18, remember, there will be no taper relief available here to reduce the tax charge. If we had survived for more than 3 years but less than 7, it is chargeable. More than 3, it is the tax charge that will be reduced by taper relief. Be very careful here. Taper relief reduces the tax charge. That is the tax of 30,000. It does not reduce the amount of transfer that was chargeable to tax. Taper relief reduces the tax charge. Here there is none because the donor did not survive for more than 3 years from the date of the gift. Now, as the nil rate band has been fully used on the lifetime transfers, the entire chargeable estate of 750 will be taxed at 40%, giving therefore a further liability of 300,000, then to be paid by the personal representatives. Remember, when will that be paid? It will be paid by 6 months from the end of the month in which the taxpayer died there. But look again at the amount of tax now payable on the death estate. That now there is no nil rate band. This time, again, all of our nil rate band has been used up by those lifetime transfers there. So again, take a moment just to have a look through the examples that we have done here before we go back and cover other issues that we've skipped over so far as this basic discussion of calculating tax on lifetime transfers and on the death estate is concerned. Just have another little look at that, please. So what we've seen so far, therefore, is that when a taxpayer dies, chargeability to IHT will arise in relation to 2 categories of transfer. Firstly, and most importantly, firstly to compute, is any IHT payable on lifetime transfers made purely within the 7 years before the date of death. What we've seen is that although the main IHT rate on death is 40%, there is firstly this incredibly important nil rate band that applies. We have to know how it applies. It applies firstly to the lifetime transfers made within the 7 years before the date of death. And within that category, if there is more than one such transfer, we apply it on a first come, first served basis. So as we kept on saying, if there were transfers 6 years before death, 4 years before death, 2 years before the date of death, then we would utilise the nil rate band on a first come, first served basis, the earliest transfer first, applying firstly against the transfer 6 years ago, before 4 years ago, before 2 years ago. Having computed the amount of tax that is then payable, i.e. have we gone above the available nil rate band on those lifetime transfers, once we've dealt with those lifetime transfers, we then move to the death estate. And the content of the death estate will then be taxed, that chargeable estate figure, again using, if there is any available nil rate band, so did the lifetime transfers within the 7 years before death exceed 325 or not, but if they didn't, then any remaining available nil rate band will apply to the death estate and the balance will be taxed at 40% there. So incredibly important to know how to apply that nil rate band. And as we've seen, it applies firstly against lifetime transfers and then only if some is left over against the death estate. But frequently, of course, and usually, of course, within the death estate, will be the deceased, the individual's their main residence, their home. And it has often been said how harsh it is then that where that death estate is charged to tax, possibly the main asset within it being the family home, the main residence there, how then potentially huge amounts of tax become payable, such that maybe the kids, if they are the beneficiaries of the family home on the death of the taxpayer, may have to actually sell that property in order to pay the tax that is due thereon. So it's long been said that something should be done in this situation where within the death estate the main residence is being left to a direct descendant, the children or then the grandchildren, that maybe a further deduction, a further nil rate band should be available purely against the value of that main residence, that property. And so it is, therefore, that we now see here in the notes that new to the 2017-18 tax year, for individuals dying from the 6th of April 17, there is this additional residence nil rate band. So we've had the nil rate band, we're now talking very specifically about this new one, the residence nil rate band. Now it's not a huge figure, but any amount is welcome. And it is £100,000 in 2017-18 and destined to go slightly higher in future years, but for us it's £100,000. And this residence nil rate band is only available where a main residence is held within the death estate. So a number of things need to combine together for this residence nil rate band to be available. Now it's only available in relation to where we have the main residence, and you will be told the examiner has stated that a question will make it clear if the residence nil rate band is available. Therefore you should assume that the residence nil rate band is only available if there is mention of a main residence. So it's only available where you've got a main residence held within the death estate and it is inherited by direct descendants, children or grandchildren. That was why in illustration 2 here, as we mentioned, the residence nil rate band was irrelevant because it wasn't available as the main residence was not left to a direct descendant. Where had it been left to? Nieces and nephews. Nieces and nephews, those are the kids of the individual's brothers or sisters there. They are not direct descendants of the individual. Only children and grandchildren are the direct descendants, and it is only where such a property is in the death estate and is left bequeathed, as we say, to the children or grandchildren, only under those circumstances is this residence nil rate band available, this extra £100,000 deduction from the value of that property. Now the value of the main residence is after deducting any repayment mortgage or interest only mortgage. Remember, we do not deduct any endowment mortgages there. Again, something we mentioned at the end of our first session together. Any such repayment or interest only mortgage secured on that property. If a main residence is valued after deduction of mortgage at less than the available residence nil rate band, so less than £100,000, then the residence nil rate band is reduced to the value of the residence. It's only applicable to the residence. It doesn't go against any other assets. So if the net value of that main residence to include within your chargeable estate at death is less than 100,000, then your residence nil rate band will fully cover that and we're restricted to that figure. In relation to, therefore, our calculations now, in illustration 2, we were dealing with someone who was never married and who left their estate to their nieces and nephews, the children of their brothers or sisters there. We now move on from that to consider here in illustration 3 that if our hero, you remember D, if she was married at her date of death and left her entire estate to her children, then as her main residence was left to her direct descendants, the residence nil rate band would also apply, so that IHT would now be computed as follows. Right, if we look back to what we said in illustration 2, then we got a 750,000, a 0.75 million estate, and that included her main residence, valued at £300,000. Now again, if that's included within the death estate, which it is, that 300,000, that 0.3 million, would be after having deducted, of course, any mortgages, repayment or interest only mortgages. That's the net value of that. Now clearly that is more than £100,000, so the full £100,000 residence nil rate band would be available. So now against the chargeable estate of £750,000, we would have both the normal nil rate band 325 and we'd have the 100,000 residence nil rate band, because the main residence net value in the estate 300, therefore being left to direct descendants we get the 100,000 additional residence nil rate band. So we've now got a grand total of £425,000 of nil rate band to apply. That therefore means that only 325,000 of the 750,000 remains, and on that basis therefore we can reduce down the tax charge to 130,000. That's an extra £40,000 of tax saved as a result of the residence nil rate band. Now, not that it would normally be an issue in terms of any exercises that you have to do, but in terms of there being now two nil rate bands potentially available against the death estate, the normal nil rate band and the residence nil rate band, it is the residence nil rate band that would be applied first. But again, do understand, the residence nil rate band is only available if the main resident is in the death estate and is being left to a direct descendant, child or grandchild there. Your normal nil rate band is applied firstly against any lifetime transfers made. The residence nil rate band is not applied against any lifetime transfers, only if a main residence is in the death estate. Only in the death estate, then we get the residence nil rate band, only if left to a direct descendant. But your main nil rate band, the nil rate band of 325,000, that would be applied firstly against any lifetime transfers, and then only any balance that remains from it, so only if lifetime transfers in the 7 years before death are less than 325,000 in total, would any of that nil rate band be available also to go against the death estate. Here in illustration 3 there were no lifetime transfers, so the whole 325 is available, as well as the 100,000 residence nil rate band. So look back through all of the examples we have done so far before we see you again in our next session, and we'll deal with the final issues pertaining to the application of these two nil rate bands. It is an area that has become far more interesting as a result of the introduction of the residence nil rate band, and it is likely therefore that as now the exams in this year, it is the first set of exams that could ever test that residence nil rate band, that it is going to be tested. Again, it is likely to be tested. It's a very likely area, either within section A in terms of a specific objective testing question covering involving the residence nil rate band, or as part probably of a section B question where we're most likely to find the exercises in relation to IHT. So check through all of that, make sure you're comfortable with it before rejoining us for our next session together.